So welcome to the podcast today. This should be a really interesting one, especially for you business owners. You know, when we talk about our personal finances, we'll often talk about trying to balance things in our lives around protection and wealth building. And regardless if you're thinking about your personal finances or your business finances, they're still applicable, right? I would argue that in the business side, there's probably even more risks to manage, right? That someone who's just maybe working a job and, trying to manage everything else in their lives have to deal with. So today I'm really happy to have Chad Spitzer with us today. He's from Higginbotham. I got to meet him and his brother and his father. I love the fact that they started off working in a family business, but now they work for Higginbotham, a property casualty company. And, they are experts in the space of, I think, a little known topic area of captive insurance. We're going to cover a little bit about that and why you as a business owner should care about this and what to think about. And so we'll get into this world. So first off, Chad, I'd like to introduce you and welcome to the show.
Hey, thanks so much. Appreciate you having me.
That's great. It's great. So Chad, before we get cracking on any of this stuff, love for you to share just a bit about your background with the audience.
Sure. Yeah, so background-wise, study-wise, I studied finance in college, and then went and worked at Ernst & Young in Dallas in their valuation practice. So while we do have a family-run business now, each of us worked out in the corporate environment in tax consulting practice. I was in Ernst & Young, the valuation practice. Another brother's attorney with Exxon, the father who was a CPA for 30 years or more. So each of us worked elsewhere and then slowly came over one by one until we eventually sold our business, like you had mentioned, to Higginbotham, which is the largest property casualty broker in Texas, where we now have been for just over 3 years. So that's what kind of led us to here anyways.
Oh, that's wonderful. So, and I love the fact it's a family business. Maybe we'll get a little bit into that too. It's, some people say don't work with your family, but it seems to have worked out for you guys.
Yeah, absolutely.
So what about this, insurance? Me getting into sort of the life insurance system, I never thought I'd land here.
Yeah.
So, what do you love about what you do today?
Yeah, so I think what we like most is that it serves the purpose of helping those, as you mentioned before, risks that they have in their business and trying to financially finance those risks through their own insurance company. So that's what we like to do, is to help those people that are having significant risk issues in their business where they may just be wondering, is there an available option that's maybe not out there on the commercial market that I could do? Or is there additional coverage we could get in this scenario? Or, hey, I'm paying a lot in premium, but haven't had a lot in claims. Is there anything I can do to potentially save on that premium? Finding alternative risk solutions through the use of captive insurance companies has been done for decades, but that's what we help business owners do. It's becoming more of a hot topic and a buzzword over the last several years as what they call a hardening market. So premiums going up, as you can imagine, with natural disaster type stuff. A lot of those insurance carriers are experiencing significant losses. So because of that, across the board, on the property side and all other lines of coverage, to try to mitigate some of that risk from the carrier perspective, they have to raise premiums, which ultimately hurts the business owners like some of your listeners. So we enjoy that aspect of it, that we're able to hopefully provide a solution, which is, here's how we can potentially save you dollars on premium by utilizing a captive. Here's how we can help you potentially find coverage for something you would otherwise not have coverage for. Or here's the ability to put money aside so that you're building up surplus and have money available to cover on some claim that may occur in your business that you otherwise are just sitting back and waiting for the blow. But why not get ahead of it and try to finance some of that risk before it comes to you?
Yeah, no, absolutely. And getting down to some of the basics around it, I think everyone, whether it's personal or their business, they want to protect their assets they're building, their families, but they just don't like paying for it, right? This is where you can come into play. So how do you more efficiently fund those things so you can focus on growing your business, right? And the joy of the business side of it, right? And not have to worry that you're kind of driving blind and hopefully you make it through the corner unscathed, right?
Exactly.
Right. So let's, and I think you kind of touched on a little bit there. And, for people who don't know, like what really is captive insurance? Kind of what's the background on like how it started? Why does it exist?
Yeah, so captive insurance is literally setting up another entity. So this is a completely separate entity from what the client or the insured may be. So when I say insured, let's think ABC Manufacturing or ABC Construction Company. They operate, they pay for their insurance with their current broker, and they have a carrier involved. But this is setting up a different entity, ABC Insurance Company, to cover the risk of ABC Construction Company. So it's its own EIN, its own bank account, own articles of corporation. Everything is completely separate and a completely new entity. So the idea behind it is, well, if we set up this entity, what are we able to do with that? Why do we need to do it? And what's the purpose of it? So we typically look at a few different ways to utilize it, which I touched a little bit on before, but it's to cover for maybe large deductibles that they have, large retentions, to cover for maybe gaps in coverage that they have on the commercial side, maybe to cover for some different risks where there's not availability on the commercial market, or maybe it's that they want to purchase some reinsurance and maybe get fronting carriers. Well, it gets a little more complicated in those situations, but maybe it's that they're paying a significant premium, and we look to save them some premium by sending up a captive to take on some of that risk that's related to their business and to that policy specifically. So the whole idea behind it, though, was the ability to put money into your own company that you own 100% of. I guess just to state that this new entity is owned by the same owners as the insured, or who they would like to be the owners of it. And it is paying premium and deducting on their business side on ABC Construction and going into ABC Insurance Company, which is an entity that they own. So there's efficiencies financially in putting those dollars aside, which is why this industry came about, is so that they can have those dollars put aside and available to cover for a claim. For example, a very basic scenario to look at is, hey, on our commercial side, a lot of people are experiencing this, wind and hail coverage or other property coverage where the carrier is forcing them to take on huge deductibles. They may have a $10 million building and they're saying, hey, you have to take on 10% wind and hail deductible. So they're exposed to $1 million if there's a tornado that comes through, or a hurricane, whatever it may be. So they're just bracing for impact if something happens. Well, what if we set up their own insurance company where we then go to a third-party actuary and say, hey, how much does it cost, or how much can we pay in premium to our own insurance company to cover that risk of that big deductible? So we're not going to change our commercial program. We need that in place. But it would be nice if we could get some money put aside in an economically efficient way so that we can build up some more surplus quicker, so that when we do have a storm come through, which we know is going to happen eventually, we're able to then pay out that massive $1 million deductible that we have. Instead of just keeping it inside of our business, we're going to pay tax and lose those dollars, and we can't build up surplus, where we get a lot of benefits over here with reserves and premium calculations, earned premium calculations that allow us to build up surplus faster so that we can actually pay on those claims. So the idea again behind all of it is putting money aside into your own insurance company to take on additional risk, to also do it in an economically efficient way so that you have the dollars ready with surplus built up to cover whenever that potential storm either literally or figuratively comes through to your business.
Yeah, that makes sense. And it's obviously a way above, like we on the personal side, dealing with people who they quote unquote self-insure, wherever they're throwing money to store it for, whether what rainy day or a massive catastrophic thing. Well, people really don't do that. Right. So, I kind of say that's really not insurance. But this is actually putting into something that is an actual entity that, has all the structure around it that's aligned to an insurance company. It's within your own organization and you can control it, right? And all those good things around storing dollars for that rainy day will be there, right? And it's sort of more formalized. Is that an accurate sort of description?
Yeah, no, it is accurate. So, and the other benefit is when it's going into your own insurance company, that insurance has a bank account, an investment account where those dollars can be invested conservatively, right? It is an
Mhm.
insurance company and acts like an insurance company. So, but you can earn on those dollars, now you can make 4 or 5% in your sleep with the high interest rates. So the ability to build up that surplus and invest those dollars so it's ready for a rainy day is also a huge benefit. But no, how you just described it is exactly how it works and why it works is for those reasons.
And and I know this is where there's maybe different types of, just like if we think about life insurance, there's different types, like, whether it's, owned only by the company or maybe shared across common. Can you talk more about that?
Yeah, so there's different structures in the captive world. So kind of what I'm referring to today is talking about what they call a pure captive or a single parent captive, where they own 100% of it, right? There are other captives, which Higginbotham has the expertise in this as well, is group captives, where it's very common for people to know about that because maybe a trucking company or someone where they have a significant amount of auto liability insurance, workers' comp, or general liability. Those three lines of coverage, if you're paying 250, 300,000 or more, for those, a lot of times they'll go into a group where they have a percentage of the pie or a voting share of the pie, and they participate in that way. In this case, we're talking about where you own all of it 100%. And by the way, the group captive is very powerful and works for a lot of people. But it may be that the group won't take on certain risk, and this may be a better option for some people. But setting up a single parent is where they dictate how they want it owned. And it's owned by the insured or the owners of the insured or whoever it may be. So that's what a single parent captive does. Now, that single parent, a lot of times to purchase reinsurance, like we say. So, for example, let me go back to my example of the $1 million deductible they may have for wind and hail on their building. They may not feel comfortable taking on the bill, although they don't have an option, right? The carrier may be forcing them to do it. Well, what if when we set up the money aside in their captive, if they could have reinsurance to help cover for that $1 million so they're not on the hook financially for all of it? So this is still them owning it 100%, but they can participate in our reinsurance risk pool that we manage, where there's 130 plus captives. So they still own 100% of it, but they are a percentage of that total pool, where if they had, say, that $1 million claim, they may only pay 250,000 of it, and 750,000 of it would come from those in the pool. So I think sometimes people confuse those things, saying, "Oh, well, that's a group captive." Well, no, that's not a group captive. It's still single parent, but you're purchasing reinsurance by participating in this risk pool where you're sharing risk with each other. But the benefit there is that you're able to receive help financially on, say, these large deductibles or these other exposures that your business has. So you're not taking on the full risk of, say, $1 million limit. You can get help from that reinsurance.
Oh, I get it. And it makes sense. And, and it sounds like because of the things you guys are helping protect against, I mean, this is probably viable for virtually any industry. Are there some industries that are just better suited for captive because there's not a great sort of offering broadly, commercially, for the protections?
So certainly when we talk about the group captive side, there's going to be more limitations in some aspects on industry. On our side, there may be limitations as far as where does that reinsurance risk pool really want to participate? There may be some risks that are just hitting too often. There's too many claims, or maybe it's just the industry can be a little bit scary, so we don't necessarily want our risk pool touching it. But when you're doing a single parent captive, you have way more flexibility. You're ultimately deciding what you would like to insure for. So there is a lot more options and flexibility when you're owning your own insurance company to say, hey, regardless, we want to put money aside to be able to cover for these situations. So there really isn't a whole lot of limitations from that perspective of what they're able to price with actuaries and put aside into their own insurance company to cover for it. Now, where we go get reinsurance to help on those bigger limits, that can be a little more limiting based on the line of coverage or industry, but not very much. There's not a ton of limitations, very few.
Oh, very good. Very good. Can you talk, and just like any insurance company, right? You're pulling risk, right? And even though you kind of own it in this scenario, but that you said those dollars could be that are being stored ready for it, right? Just like the float, right? That you can actually invest those things. Can you talk a little bit more about that and what that looks like and what they might be able to invest in, right? These dollars are sitting there.
Yeah, so we have all of these insurance companies are regulated by departments of insurance in each, whether it's a country, one of the islands, or a governing body in the states, one of the states, and their departments of insurance, they have captive divisions that regulate these. So with those regulators, there's approved investment policy statements. Some can be a little more broad or more specific. We have one approved by the Department of Insurance where it states kind of just asset classes. Hey, you can be in stocks, bonds, ETFs, whatever it may be, but we can't go say put 100% of our funds into crypto or into one stock in case that all of a sudden tanks and you don't have money available to pay on the claim. So the idea is just being a good steward of the money so that we're not overly risky with our investments, so that those dollars are available to pay for claims, right? This is not just an investment vehicle. This is a true insurance company. So while we do have the ability to invest those dollars, we need to make sure we're investing in a way so that if the unexpected claim occurs, which is standard insurance, right, and come out of nowhere, we need to be able to pay on that claim if it were to come up. So you do have flexibility within that investment policy statement. And especially in that first year, if you think, hey, this is my first year setting up a captive, we would likely have to be a little more conservative in that year because this is our first year. We don't really have any surplus. This is it. So once we make it through a full policy period of 365 days, and then we work with our actuaries to determine, hey, what kind of reserves do we need to have for potential claims that could occur and so on, and we then pay the second year of premium, now we've started to build up a little bit of surplus. So it may be, hey, with those first year funds, net of the reserves that we've calculated, maybe we can be a little more aggressive with those dollars because we know we have this second year of premium that's now come in. So we can be a little more aggressive with these other dollars to try to build up the surplus for claims because we know we now have got surplus coming in. And that continues on, obviously, each year with additional dollars that come in, net of losses. Where we can have a little more flexibility with how we invest. But initially, we got to be a little more conservative so we make sure those dollars are available since we don't have any surplus prior to that.
Yeah, that makes sense. And so any other benefits to that too? Because if I'm thinking very simply, well, if I worried about this risk and now and I don't do this, right, I can maybe set some money aside in a bank account or wherever, right, as a rainy day fund. Is there ways to use this for financing to support the business at all, or any other benefits that come along with this?
Yeah, you're exactly right. That's kind of the comparison that we do is, okay, what if we have a large deductible? I'll stick to my $1 million on your building, right? You have your $10 million building, 10% wind and hail. So we're exposed on $1 million. Well, I'm just going to go start putting money into a bank account on the side so that when something happens, I have those funds available. Say we start doing that today or May 1st, and between now and the end of the year, we want to try to get $1 million into that account so we know, okay, if something happens on our building, we have the money set aside in a bank account. But when we get to 12/31 and we haven't had a loss yet, well, then you're going to be taxed on those dollars that you pulled out of your business because that's the operating dollars out of your business. So ultimately, you're going to give a big, decent chunk of that to the government for tax, which makes sense. But that's the whole purpose of the captive side is, well, man, there has to be a way for me to put these dollars aside so that I'm not just paying tax on all of them immediately because I really need those dollars to pay on a claim. Because, hey, I started putting money in from May 1st to 12/31 to the end of the year. I didn't have a claim. I paid tax on it. Then January 15th, we all of a sudden have a huge loss. And I already gave a lot of that money back for taxes. Why didn't I not have the ability to save those dollars up and now pay on that claim because I otherwise have paid all of it in taxes. So that's why captives were formed partially, is so that we can deduct that on our business side and put the dollars aside so that at 12/31 we're not paying all of that in tax. There's some tax paid along the way in the captive as well, potentially, depending on how it's structured. But you can put those dollars aside and build up surplus. So that's where, with the IRS tax code, we have to make sure we follow that, but it allows for us to have certain deductions, such as the reserve calculation done by the actuaries that lowers that tax burden. So you are building up surplus much faster. So that's part of the analysis of what we do is analyzing, hey, there are fixed costs involved with us managing an insurance company for you. We want this to make financial sense for you. So if there's not enough premium dollars, And it makes more sense for you to just put it into a bank account and let it build there versus actually putting it into a captive and building up surplus that way, net of our fees, then we're going to tell you, hey, just put it into a bank account. We want it to work for the client and for it to make sense financially, because that's ultimately the whole purpose of the captive, is that they're better off financially. Not that we need to manage another captive. That's not the object here. So that is why there is strength in utilizing a captive and comparing those two different scenarios.
Yeah, no, that's great. And just like, and this is why when you hear about this, and there's just like you can research life insurance, there's tons of negative things that get said about it. And there's some things I've seen over the course of my years looking at captives too, that, some people will take advantage of something like this and use it as just a tax strategy. It's really a risk mitigation tool, right? It just comes with some potential tax benefits, and it helps protect the business, right? To make sure it's viable, keeps going, right? Gives more jobs, right? All that sustainability. That's the primary focus of why this was created.
Yeah, you nailed it. That's one of the biggest focuses that we have, is that while there are potential tax benefits side of it, the only reason there's tax benefits because that's the only reason it makes sense for an insurance company to ever do this. I mean, if insurance companies in the United States had to pay tax on all of their dollars at the end of the year, none of the carriers would even have money available to pay on claims. That's the reason that they've structured it this way. There's a couple of different ways a captive can be taxed, which I could talk about for days. But yeah, if you go look up how insurance companies are taxed, and there's those that can make what's called the B election under the IRS tax code, there's more scrutiny there, just as you said. 10, 15 years ago, you had people that were abusing that and taking advantage of it and not properly structuring a captive and doing it for the wrong purposes, where that ultimately the IRS attacked them, and for rightfully so in some scenarios. Whereas now those that are doing it correctly can be damaged a little bit by that. So that's why we have our ear to the ground on all that stuff. We can talk about it for weeks on end about that, but that is why it's available. And you're correct. This is why we do it, which is for risk mitigation, to put the dollars aside for that purpose. Yes, there's an economic advantage, but that's because that's the only reason it makes sense from an insurance perspective, is that there needs to be one in order to pay out these claims. So we're doing it for the right purpose. They're for true risk mitigation, act as a true insurance company. You nailed it. That's the biggest aspect of all of this.
No, it's great. And I want to go back to something you talked about a little bit earlier and just dive a little bit, because, for anyone who's listening to this as a business owner and you think this might be interesting, you might be thinking, oh, now do I have to manage this insurance company? I don't know anything about this industry, right? Yeah. I got my own business to run and manage. So just share kind of what your company does and what you guys help the business owner manage.
Yeah, absolutely. So you'll hear we're captive managers. We're licensed captive managers. That's what we do. So there's a few different aspects of that. Obviously, the beginning side is just educating a potential client or an insured on how it could potentially work. We then go to the next step, which is engaging third-party actuaries, which we handle all aspects of all of this. But engaging third-party actuaries and doing a full underwriting of analyzing your current commercial policies, analyzing where the risks exist in your business, how are you potentially wanting to utilize the captive, and pricing that appropriately that match the risk and limits involved in each of those lines of coverage. And then from there, you then have to have someone that engages the regulators to, you got to work with getting set up with the IRS on their system, work with the regulators to get it approved with a business plan. We have to get articles of incorporation done by the state. We have to get bank accounts set up. All of that we handle as well. So it is not on the client to have to figure that out. And then beyond that, it's every year we're having to do different things. For example, we have agreements, we have policy issuance, we have repricing those risks with the actuaries. Each year we have reserve opinions done. I touched on that a bit. How much do we need to make sure is set aside? We haven't had a loss, but what are potential claims that can happen in the future we don't know about? What do we need to reserve for in those cases? We engage the actuaries to do that analysis each year. We have a financial statement audit done each year with an audit firm. We do all the books and records and accounting each month and each year, the tax return, premium tax that needs to be paid to the domicile, premium tax return, all of these things, claims that come through, managing the pool of everyone interacting with each other in those agreements. So we handle all aspects of that. None of that has to be passed on to the client. The biggest part with them is making sure we're engaged with them as it relates to their risk, having annual meetings with them, following up throughout the year to make sure if they have claims that we know about them, to make sure those are filed properly, and then having them engage and work with the third-party claims group to make sure that that's all verified for claims to be paid out. So we handle all aspects of that. We do not have the client that has to figure out any of it other than just engaging with us a few times a year on calls and meetings to make sure that we have everything set.
That's great. Yeah. So it sounds like pretty turnkey in that respect.
Exactly. Yes.
Yeah. Yeah. Listen, I that, as you know, you deal with a lot of these business owners. I mean, there's some are just got 2 seconds of time to spare because they're just have a lot to manage. So it's good to hear that, not going to require a lot of extra effort on their end, but certainly it still requires some level of engagement, a couple times a year.
Absolutely.
Right. Using your consultation. So I guess it sounds great. So I guess there's probably minimal requirements for folks to where this makes sense, like you said, from a financial perspective. For anyone who might be interested in seeing if this is even remotely an option, how best to kind of get started.
Yeah, so I think internally before they reach out to anyone, and maybe it comes up when they're working with your broker or whoever it may be. We work with all different kinds of brokers, so we're able to do that. But it's just, hey, are there risks that we have in our business that we currently don't have coverage for, that we wish we could put money aside for to cover? That's one analysis. 2, do we have huge deductibles or retentions where it's going to be a big hit to our balance sheet and our income statement if all of a sudden we have something that comes through and we have to pay out on those deductibles? Or are we paying a significant amount in premium right now without a lot of claims or losses? Is there some way we can better find an alternative risk solution here to help us save on those premium dollars, maybe take on a little more risk in doing so, in order to better our program and our risk mitigation strategy? And it may be a combination of all 3 of those things, or just 2 of them, or just 1 of them. So I think it's really just looking at it from that perspective of what risk do we have? Ultimately, if there's an insurable risk, not just a business risk, but an insurable risk, then there's a potential for it from a captive perspective, so long as the dollars make sense, that there's enough risk there to produce enough premium for it to really work for them. But I'd say those are kind of the 3 categories. You have huge deductibles and retentions. We want to self-insure some aspect of our business, or get coverage elsewhere, or we have a significant amount of premium that we're paying. We would like to self-insure for that, or get some reinsurance, take on some more risk. Those are all options of how to analyze in a business of where it can potentially make sense. And from there, if they say, hey, we want to engage with you, all we do is look at, without any charge to anyone, obviously, is show us what the lines of coverage look like you currently have, those premium dollars, show us what those losses look like, and let's see what kind of program we can build out and see where it makes sense to better structure some program for your business. That's
great. Yeah, and it's just more of a curiosity to me too. I mean, because there's just so many risks, and some of them we don't even know they're out there, right? As for personal level, even business wise, is there anything that kind of comes to mind, or you see that maybe becoming more of a bigger risk as we move forward here that maybe business owners don't appreciate kind of the exposure they're facing?
I think most business owners know it, and maybe not all own their buildings, but property is a huge exposure now, and the fact that a storm comes in there can be potentially some climate differences that make that more of a risk, but storms are coming either way. But the bigger risk to them is just the financial risk of it, because carriers are forcing them to take on higher deductibles or pay more in premium because of it. That's one aspect of it. Beyond that, new risk coming about, cyber, directors and officers, errors and omissions. Those are coming more and more because we become such a country that likes to litigate, right? So if something goes south, everyone just wants to sue. So especially from the business owner's perspective, if they don't have those types of coverage in place to cover themselves, those are places where it get a little bit scary. So a captive, hey, we're not saying everyone needs a captive, may or may not be a fit with those specific clients, but those are some of the things nowadays that are more risky. From a financial perspective, property is more risky. From a business perspective and personal perspective to the owners, directors and officers coverage those types of things, errors and omissions, professional liability, where they can try to come after you for just anything, which happens all the time, is where there's a lot of risk these days.
No, that's great. This is awesome. Chad, I really appreciate all you shared here. It's a tremendous amount of information, and I know it'll be very valuable for our audience here. Any last words of wisdom you'd like to share with business owners out there around captive insurance that we didn't cover?
Oh, wow. No, I think, don't be afraid if it's just you hear the word, you don't know anything about it. We're happy to educate people. We obviously, again, we don't charge anything for that. But if you feel you have risk in your business, both just in your current program because your deductibles are high, if you're paying a ton in premium without a lot of losses, or if there's some program you're looking to build out or find coverage that you don't currently have or self-insure something, reach out. We're happy to talk through any scenario. Even if it's not a fit, we can explain what the opportunity could be. So don't be afraid of from that perspective. We're happy to help out.
That's wonderful. Awesome. And as I always preach to people, I say, you control the controllables, right? What risk can we mitigate and bring more certainty to our lives? I don't know about you, but I don't always love surprises. And I certainly wouldn't want ones that are potentially going to ruin my personal finances and certainly my business. So, Thanks for providing such great service for business owners. And so how best to reach out to you, Chad, in Higginbotham, or if anyone's interested?
Yeah, so best is probably by email. You want me to provide that now, or how should we do that?
Sure, we'll put it in the show notes.
Oh, you just put it in the show notes? Then yeah, we'll have it in there. But just my email, phone number, text me, email me, call me. Any of those are totally fine. We're happy to answer questions that way.
Wonderful. Well, thanks again, Chad. I appreciate your time and sharing everything, and we'll definitely be in touch and connect you with folks who really could benefit from your services. So appreciate it.
Thanks so much for having me.
All right. Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.